So my background was I started my career as a chartered surveyor with Knight Frank and Rutley, which rather ages me. That was 1990. And in 97, I moved to Henderson Investors to work on TR Property Investment Trust, initially on the real estate side, and then from about 99 onto the real estate equity side, plus other funds there. I took over from Chris Turner in 2011. By that stage, we'd moved to a shop called Thames River Capital, which was subsequently acquired by, through various iterations, we're now part of Columbia Threadneedle. So I've been the fund manager of TR Prop since 2011. So the fund has a very clear investment objective, well, essentially two, but the major one is I'm there to beat the benchmark, which is the FTSE EPRA Nareit developed Europe total return in sterling. That's quite a mouthful, but essentially pan-European real estate equities. The board also set the agenda of attempting to pay a growing dividend from that, because obviously the vast majority of the annual returns over long periods of time from real estate comes from the income side rather than capital growth. So our investment process is very much a relative call. We're there to beat the benchmark, as I said, but essentially we're not having target prices. We're looking at selecting the best stocks producing a total relative shareholder return over a period of time within a set of risk parameters. The thing that's really interesting and differentiates us from all of our competitors is the fact that we're closed-ended permanent capital. That allows me to particularly focus on small and medium-sized companies, which we are able to help grow. The thing about the equity market is small companies are quite often under-analysed, sort of slightly left to their own devices, and they can present fantastic opportunities, either to merge them with other companies or to be taken private, or hopefully to grow, and we support as many as we possibly can. So the idea generation really comes from a mixture of bottom up and top down. We're looking for stocks that are essentially in markets where the tide is flowing in the right direction. We're looking for markets where there is fundamental tenant demand, where investors will follow. Sometimes these are already existing sectors, sometimes they'll be embryonic, relatively new ones, sometimes they're just sectors that have gone out of favour and we think are cheap. Within that space, we're then looking for the best type of business to execute that strategy. So if it's a fast-moving market where we think it's a particular sub-market which is undersupplied, then we're going to be looking for businesses that have development opportunity, repositioning opportunities, rather than just sort of standing portfolios. On the other hand, if it's a value play where we think in fact that actually there's just an opportunity to grow the income reasonably quickly, but it already has quite high income, then we'll be looking for a business there which has very little development. So it all depends. It's sort of horses for courses through the cycle. There are moments where we're trying to minimize gearing, minimize debt, which is what we've seen in the last couple of years. We're very much coming out of that into a world where we're looking to increase our level of debt, both at the fund level, but also from a see-through basis. In terms of our hold period, there's really no standard hold period at all. I've got stocks that I've held throughout my entire fund management career, others where we've been in and out in a matter of months. What we don't do is sort of day trade these stocks. So in total return terms, we've returned 27% over 1 year, minus 15 over 3, plus 6.5, 7 over 5. So essentially what you've had there is the recovery in the market over the last 12 months, which we expect to continue on the back of falling interest rates. The 3-year figure, of course, was through the bear market, which was a result of interest rates rising so rapidly, and 5 years is sort of the combination of the two. I would add that since I took over the fund in 2011, the NAV return has been 190%. Versus 86% for the benchmark. So we have had significant outperformance of the benchmark over that period of time. So the fund's overall cost is about 65 basis points, which comprises we're quite unusual as a fixed base fee, which at the moment grows with sort of indexation plus. That's about 4 million plus 20 basis points of ad valorem cost. So our AUM at the moment is about 1.15 billion, and therefore that equates to roughly 65 basis points, which of course, as the AUM grows and a chunk of that fee is fixed, then of course the actual OCF in percentage terms comes down. On top of that, we can earn a performance fee. The performance fee is basically we have to beat the benchmark after all costs, plus another 100 basis points, and after that we can receive 15% of the upside, which is then capped. So this was set in place a very long time ago, I think 6 chairmen ago, and what he wanted to see was us be rewarded not just on when the market grew, but when we beat the market by a significant margin. In the same way, if everything fell very quickly, he didn't want us having to sort of lay off staff. So it was quite an intelligent way of looking at it, and we think it's a great structure.